Welcome to The Deep Dive. We're the show that cuts through the noise to bring you what really matters in finance.
Glad to be here.
Today, we're digging into the recent earnings call from FRMO Corp. That's ticker FRMO.
Right. We've got insights from Chairman and CEO Murray Stahl and President and CFO Stephen Bregman.
And our mission, as always, is to unpack their strategy, especially around digital assets and investment management, so you get the full picture.
Yeah, it was a really interesting call. They definitely have a unique way of looking at things.
Especially asset valuation, right? Like Bitcoin and their mining operations?
Exactly. They really emphasize what they see as a strategic advantage in their mining approach compared to just holding, say, a Bitcoin ETF.
How so?
Well, they view mining as a business where the assets, the actual number of coins, can grow.
Right.
It's not just about the price going up.
Interesting. And they talked about Winland, too.
Updates there. Noted its premium valuation, and they're still trying to increase their stake.
Horizon Kinetics was another big topic. Seems they see a potential turning point.
Yeah, favoring active managers like themselves. They tied it to potential shifts in corporate tax rates and some structural issues they see in indexing and private equity.
Okay, and the balance sheet. What stood out?
Holdings in securities and crypto, as you'd expect. The digital assets were mainly mined Bitcoin.
Okay.
And they mentioned their short position in those past-dependent ETFs again. Seems like a steady cash contributor.
They also had to address the book value changes, I assume, TPL.
Right. The mark-to-market on their Texas Pacific land holdings definitely impacts things. And they explained their indirect Bitcoin mining strategy, too.
Through Winland and Consensus Mining.
Yes, as a potentially more efficient way to stack sats, basically.
Got it. And that big jump in fee income.
That was a significant performance fee from Horizon Kinetics Holding Corp. Also, dividends were strong, especially with an extra one from Msabi Trust.
Okay, quite a bit to unpack there. Let's dive deeper into that digital asset strategy first. It sounds pretty distinct.
It really is.
Yeah.
The core idea, is this sharp line they draw between just holding digital assets, maybe in a fund or trust, and actually generating them through mining.
And they prefer the mining route?
Strongly.
Yeah.
They see mined Bitcoin as, well, fundamentally better because the actual number of coins they own can increase organically over time.
Right, not just the dollar value fluctuating.
Exactly. It's growth in the underlying thing itself. That's the key difference for them.
And this thinking directly informs their investment in Winland.
Precisely. Winland, being a corporation focused on crypto mining, is kind of their showcase for this idea. They want to demonstrate it's superior to just passively holding Bitcoin in an ETF.
And the market's agreeing, at least based on the valuation.
Well, the fact that Winland often trades at a premium to its net asset value, FRMO certainly points to that as supporting their thesis.
Yeah. They also said they're buying more Winland, even putting some in HK Hard Assets 1.
They've started adding to their position again. It seems like a strategic way to use their cash flow and, maybe speed up the growth in that mining exposure.
But they did acknowledge the challenge for miners post-halving, right? Profitability concern.
Oh, absolutely. Yeah. They mentioned that just running standard rigs for Bitcoin might get really tough, maybe even unprofitable, because the rewards are cut.
So what's the plan?
Their answer is leaning more heavily into indirect mining.
Explain that again.
So instead of mining Bitcoin directly, they mine other cryptocurrencies that offer better returns at that specific moment.
Okay.
Then they take those mined coins, sell them for cash, and use that cash to buy Bitcoin.
So they reckon they can end up with more Bitcoin that way than if they just mined Bitcoin directly.
That's the idea, especially with the halving reducing direct Bitcoin rewards. They're actively ramping this up in both Winland and Consensus Mining. It's like a more flexible approach.
Okay, interesting. Let's pivot to Horizon Kinetics. Management sounds pretty bullish on active management making a comeback.
Yeah, quite convicted. Their main point is that the last, 15, 17 years, from about 2007 to 2024, were sort of an unusual period that really flattered passive strategies.
Flattered how?
A big, often missed factor, they argue, was the massive drop in corporate tax rates for the huge multinational companies that dominate the big indexes.
Like Apple, Microsoft, Amazon.
Exactly. They listed a bunch Meta, too, pointing out how much lower their effective tax rates are now compared to, say, 2007 or whenever they went public.
So the argument is lower taxes artificially inflated the earnings growth for these index leaders.
That's the core of it. They're saying if taxes had stayed high, the earnings growth wouldn't have looked nearly as good.
Right.
And therefore, that tailwind, that tax cut benefit that helped index funds, Well, they don't think it can continue. And it might even reverse.
And if that happens, the playing field levels out or even tilts towards active pickers like Horizon.
That's the thesis. When that macro factor fades, fundamental analysis and picking the right stocks becomes more valuable again. Plus, they mentioned issues with small cap indexes like the Russell 2000.
What issues?
Like how underperforming companies tend to just linger in those indexes, unlike the Russell 1000, which kicks them out more readily, sort of a structural drag.
And they also brought up problems in private equity.
Yeah, liquidity issues. They cited a huge drop, like 85% in exits, IPOs, acquisitions, that kind of thing.
Wow, 85%.
Yeah. So it's much harder for PE firms to cash out. And they link that partly to all the money flowing into index funds, which have rules that make it hard for newly public companies to get traction outside those indexes.
So less competition, maybe more distressed opportunities potentially spilling into public market.
That seems to be the implication. All these factors together, they believe, position an active manager like Horizon pretty well.
And Horizon itself is doing okay. AUM up, potential for fees.
Yes. They mentioned growth in assets under management and talked about performance fee potential, tying it back to strong results in some long-held names.
Like Texas Pacific Land and the Bitcoin trusts.
Those were specifically mentioned as key drivers.
Okay, let's shift to the FRMO balance sheet itself. Digital assets, $13.7 million, mostly mined Bitcoin, you said.
Primarily Bitcoin they've mined over time, yes.
Yeah.
And up $1 million in the actual mining rigs, the equipment.
Got it. And that loss reported in the last quarter. Can you clarify that again?
Yeah, important clarification from management. It wasn't an operating loss. It was almost entirely due to the mark-to-market hit on their Texas Pacific Land shares.
So just the paper value changing between reporting dates.
Exactly. Between November 30th, 2024 and February 28th, 2025, the price went down, so they had to record that change, not a cash outflow from operations.
Okay. And there's a $4.6 million payable to FRMO from Horizon Kinetics Holding Corp.
Right. That's the performance fee Horizon earned for the 2024 revenue stream, which flows partly to FRMO. Management seemed to think it had already been paid.
And the short selling strategy, those path-dependent ETFs, still a thing?
Still a thing. They use it to generate cash. The idea is these ETFs are kind of built to decay over time.
So the profit from the decline.
Yeah, and the margin that gets released adds to their cash pile. But they did mention it's not always easy to borrow enough of these things, and they're volatile, so they have to be gradual about it.
Makes sense. And the income statement line for dividends and interest that looked pretty high, what's behind that?
Mostly dividends from their stock portfolio, which they've held for a long time. There was also that special extraordinary dividend from Asabi Trust back in November, around $6 a share.
Oh, okay.
Interest on their cash balance contributes too, but it's mainly the dividends. And the fee and other income spike that quarter was largely that big Horizon performance fee we talked about.
Got it. They also wove in the tariff discussion with the tax points. How did they connect those?
Well, they argued you can't really separate tariffs from corporate taxes in today's world. They use Coca-Cola making stuff in Mexico for the U.S. market, as an example. The point wasn't just about lower labor costs, maybe. It was more about transfer pricing, how companies allocate costs and profits internally across borders.
Which affects where they pay taxes.
Exactly. Yeah. Even if Mexican production costs were, say, a bit higher on paper, the company might structure things so the profits are realized and taxed in Mexico at a lower rate rather than in the U.S.
So tariffs, in their view, aren't just inflationary protectionism.
No, they framed it more as a potential tool to counteract that kind of tax advantage, to maybe level the tax playing field and encourage domestic production, aiming for tax equilibrium, not just higher prices.
Interesting perspective. What about Horizon Kinetics size? Did they talk about capacity limits? How big can they get?
They were a bit cagey on a hard number. Said it really depends on the strategy. Small cap is different from large cap crypto, private equity, etc.
Okay.
Current AUM is around $11 billion. But they stress their focus is really on performance, on making money, not just asset gathering or raising money.
So if too much money came in too fast?
They implied they'd have to pump the brakes somehow, maybe close strategies to protect returns for existing investors.
Right. And quickly, a couple other things. TPL buying that checkerboard land.
Main point there was, it takes willing sellers. Unlike buying stock, you can't force landowners to sell, and many might have zero cost basis and just want to hold.
Makes sense. And merging the RN fund into FRMO.
Tax issues. Current rules about ownership changes would likely mean losing RN's tax loss carry forwards if they tried merging now. So Probably not happening soon.
And just to circle back one last time, the indirect Bitcoin mining rationale.
Simply put, mine other coins that are momentarily more profitable, sell them, buy Bitcoin.
Yeah.
They believe this gets them more Bitcoin overall than just direct mining, especially now post-halving.
Okay, crystal clear. That covers a lot of ground from the FRMO call. Really distinctive views there.
Definitely.
All right, let's move to our This Is Not Financial Advice segment. Time for an outrageous but plausible trade idea inspired by today's discussion. What have you got?
Okay, so building on FRMO's conviction about Bitcoin long-term and their success or belief in the success of indirect mining. How about this?
Lay it on us.
Consider maybe a small position, perhaps diversified across a few names in some smaller, less followed public crypto miners.
Okay, the criteria.
The key is finding ones that explicitly state they're using a significant indirect mining strategy. So mining altcoins, converting to cash, and stacking Bitcoin on their balance sheet, similar to FRMO's approach with Winland and Consensus.
So leveraging FRMO's thesis, but maybe with higher beta, smaller cap.
Exactly. You're betting the market hasn't fully appreciated this indirect angle yet, especially post-halving. The potential upside could be higher if it works. But, and this is a big but,
yeah,
the risks are much higher too. These smaller miners are super volatile, face operational risks, and depend heavily on the prices of both Bitcoin and whatever altcoins they're mining. So definitely outrageous territory.
Outrageous, but plausible. Checks the boxes. Okay, another one.
Sure. Let's think about the Horizon Kinetics angle. The idea that active management is due for a comeback, partly because the tax tailwind for large cap indexes is fading and private equity is gummed up.
Right.
So the trade idea could be go long on some publicly traded, maybe boutique asset management firms, specifically ones with a strong established value investing track record, perhaps with a focus on small and mid caps.
Why them specifically?
Because if capital does rotate away from passive large cap strategies, and if private equity stays illiquid, pushing more deals or opportunities into public markets, these skilled small mid cap value managers could be perfectly positioned to benefit disproportionately.
Kind of a contrarian bet against the passive mega trend.
Very much so. You're betting against a very powerful long-running trend. The risk is that passive just keeps dominating, or the shift takes much longer than anticipated. But if Horizon's right about the underlying dynamics changing, these firms could do well.
Got it. Two interesting, definitely not advice ideas there.
Absolutely illustrative only.
Okay, that wraps up our deep dive on the FRMO Corp earnings call. We've hit their unique digital asset views, the Horizon Kinetics case for active management, and the key financial bits.
Hopefully that gives you a clearer picture of their strategy and how they see the market.
And remember, those trade ideas, purely hypothetical thought experiments. Do your own homework, loads of it, before ever making an investment decision.
For sure. Dig into FRMO's filings. Think about these concepts yourself.
Absolutely. Thanks for tuning into the deep dive. We'll catch you next time.